Tokyo's currency is trembling, and the tremors are about to shake the entire planet. The yen, long considered one of the world's most reliable stores of value, is plunging toward depths unseen in generations. Behind this descent lies a volatile mix of strategy, rivalry, and escalating international friction. This goes far beyond typical market turbulence. What we're witnessing is an alarm from East Asia's financial core, and that alarm is screaming danger to every corner of the globe. When experts describe a currency in free fall, they're not suggesting it vanished into thin air. In this context, collapse signifies Japan's monetary unit is hemorrhaging purchasing power versus dominant reserve currencies like the American dollar. This erosion makes Japan's import bill catastrophic across energy, agriculture, and manufacturing inputs. Simultaneously, it transforms how capital managers, state actors, and competing nations position themselves. The crisis transcends economics. It's fundamentally about leverage. When a powerhouse economy stumbles, rivals don't observe passively, they capitalize, and Beijing is capitalizing. While Tokyo scrambles to shore up its monetary unit, China is broadcasting unmistakable warnings, not through military posturing or diplomatic ultimatums, but via fiscal maneuvers, strategic recalibrations, and calculated interventions within international monetary architecture. In confidential negotiations, Chinese policymakers are methodically dismantling their dependence on Western currency dominance and eroding the G7's grip on global finance. This transformation elevates the yen crisis from regional trouble to a flashpoint in the struggle for monetary supremacy. Then, here's what most coverage overlooks. A depreciated yen boosts Japan's export competitiveness, yet simultaneously crushes ordinary citizens. Consumer prices surge, salaries stagnate, household budgets buckle. Meanwhile, Japanese manufacturers reliant on imported components face ballooning costs. This generates internal tension, civic unrest, electoral volatility, and when internal pressure builds inside a major power, foreign policy becomes reactive. That's precisely where geopolitics collides with currency markets. Now layer in China's agenda. For years, Beijing has constructed alternative trade corridors, independent settlement mechanisms, and expanded monetary reach across 3 continents, Asia, Africa, and Europe. As Tokyo's currency deteriorates, China perceives not merely commercial opportunity, but structural leverage to redesign global capital flows. This isn't executed through press conferences. So it unfolds via incremental regulatory shifts, bilateral accords, and financial realignments invisible to casual observers. In this analysis, you'll discover the underlying mechanics driving the yen's descent. You'll unpack how China is maneuvering behind diplomatic curtains and why those moves are triggering anxiety among established powers. You'll explore potential ripple effects on international commerce, commodity pricing, portfolio allocation, and currencies thousands of miles from the Pacific Rim. Most crucially, you'll see how this connects to a tectonic realignment in monetary governance, where influence is migrating away from Atlantic-centered institutions. There's one critical reason to stay until the final moment. The closing segment unveils 3 plausible trajectories this confrontation might follow. Not speculation, but scenario-based forecasting with vastly different ramifications, not only for Tokyo and Beijing, but for every participant in the interconnected economy. If you're drawn to geopolitical finance, concealed power dynamics, and real-world economic transformations, this deep dive is built for you. Stay engaged, because this saga is actively unfolding, and the next chapter could redefine planetary equilibrium. Welcome to America True Desk, where we decode intricate international developments with clarity and impact. To keep pace with geopolitics, economic strategy, and the currents shaping tomorrow, hit subscribe and become part of our community. For years, Japan pursued an unconventional monetary doctrine. Their global peers, while foreign central banks tightened borrowing costs to temper price growth, the Bank of Japan anchored rates near zero, occasionally dipping into negative territory. The objective was straightforward: inject liquidity into the system, incentivize consumption over savings, stimulate corporate capital expenditure instead of cash hoarding. Yet this prolonged experiment produced profound distortions. It rendered the yen unattractive to yield-seeking investors. When returns are superior in America, or the Eurozone capital exits Japan, as capital departs, the currency weakens further. This framework didn't materialize randomly. It emerged from Japan's generational struggle with deflation. For decades following the asset bubble implosion in the early 90s, prices remained flat or declined. Corporations saw margins shrink. Households postponed purchases, anticipating further price drops. Expansion slowed. Incomes flatlined. The economy spiraled into a feedback loop where tepid demand suppressed growth and anemic growth perpetuated weak demand. And monetary authorities attempted to shatter this pattern by saturating markets with ultra-cheap credit. But the fundamental challenges were demographic and structural. An elderly population, collapsing birth rates, and a contracting labor force all eroded long-term growth potential. Now, a different challenge has surfaced. Inflation, but not the beneficial kind propelled by robust domestic activity. Much of Japan's current price pressure originates externally, amplified by currency weakness. The nation now absorbs higher costs for imported fuel, foodstuffs, and industrial inputs. Petroleum bills swell, gasoline prices spike, staple goods climb in price. This elevates overall living expenses, even as wages fail to track proportionally. The consequence is household strain and small enterprise distress. International financial institutions have highlighted this precarious balancing act. A soft yen enhances export appeal. Automobiles, consumer electronics, precision machinery become bargains for foreign buyers. This benefits major exporters and inflates overseas revenue. However, simultaneously, it escalates domestic living costs and amplifies systemic fragility. Should global capital lose faith, the currency could spiral lower. That would intensify import inflation, raise debt servicing burdens over time, and constrain future policy flexibility. The central bank now navigates between opposing hazards: safeguard expansion or defend the currency, understanding each decision carries sacrifice. The yen has been sliding at a velocity that startled even seasoned market professionals. It has breached thresholds once deemed impossible for a mature, developed economy. What magnifies the danger isn't solely the depth of the fall, but the erratic nature of its trajectory. Some sessions see sharp declines, followed by brief recoveries, only to plunge again. This volatility signals a deeper narrative. Investors have lost conviction about the floor. They doubt that current levels represent equilibrium. When a currency exhibits such behavior, confidence fractures, and in international finance, confidence is the invisible foundation of stability. Japanese authorities haven't remained passive. In recent months, senior officials have publicly signaled readiness to enter markets should disorder intensify. This is foreign exchange intervention, liquidating dollar reserves to purchase yen and prop up its value. Japan has deployed this tool previously, but repetition is costly. It depletes national reserves, and effectiveness fades if underlying forces persist unchanged. The statements aim to deter not only traders, but also speculators profiting from downward momentum. Concurrently, the Bank of Japan has begun recalibrating its messaging. For years, rate hikes were unthinkable. Now, the rhetoric is shifting. Policymakers cautiously hint that tightening may arrive if price pressures and currency erosion persist, but this isn't straightforward. Raising rates could strengthen the yen by drawing foreign investment, and it might also stifle Japan's fragile recovery and increase borrowing costs for enterprises and the government already burdened by colossal debt. This traps Japan in a narrow passage. Act too slowly and the yen continues sinking. Move too aggressively and growth could stall again. Meanwhile, global investors dissect every statement, every policy release, every subtle cue. A single phrase from a central banker can shift the yen in milliseconds. The result is a currency suspended between market panic, political calculation, and the dread of mistiming intervention. As the yen deteriorates, analysts scrutinize how China might respond in Forex arenas. Weakness in one major Asian economy can provide cover for another. Cheaper yen makes Japanese goods more competitive globally. To shield its own sectors, Beijing may permit the yuan to soften as well, not through abrupt devaluation, but via gradual, managed calibration. This preserves Chinese export appeal without sparking alarm. It's a subtle approach, operating beneath headlines through monetary instruments and regulatory guidance. This pattern isn't unprecedented. China and Japan have long monitored each other's currency policies closely. When one adjusts, the other frequently responds. Historically, yen weakness has sometimes prompted softer yen management, not overtly, but discreetly through exchange rate bands and market operations. This raises the specter of competitive devaluation, where nations suppress their currencies for trade advantage. And the hazard is that once initiated, the cycle becomes self-reinforcing. Each adjustment triggers a counter move. Each decline invites retaliation. Beneath this technical currency contest lies a grander vision. China isn't merely focused on trade metrics. It has invested years constructing parallel financial infrastructure, from expanding proprietary payment networks to promoting UN-denominated commodity contracts, especially in energy and minerals. It's deepening regional financial integration across Asia, the Middle East, and Africa. Many of these arrangements bypass traditional Western financial channels. This isn't coincidental. It's a deliberate long-horizon strategy to shift the axis of influence. A weakened yen accelerates this agenda. Japan, historically Asia's financial anchor, now finds itself vulnerable. Regional counterparts perceive Beijing as more stable relative to Tokyo's monetary turbulence. This alters negotiations. It redirects trade flows. It reshapes financial allegiances. Quietly, incrementally, it rebalances economic gravity in the region without formal declarations. When observers reference flipping the G7 architecture, they're not describing a sudden coup. They're indicating a gradual redistribution of global monetary authority. For generations, the G7 nations controlled the rulebook, institutions, and conduits of international finance. Their currencies anchored trade, reserves, and credit. Flipping that system means diluting this concentration and establishing alternatives that function outside that legacy framework. China is leveraging regional influence and currency tools to advance in that direction methodically. Currency leverage means weaponizing the valuation, reliability, and circulation of your monetary unit as geopolitical capital. When China negotiates trade settlements in yuan rather than dollars, it diminishes Western financial infrastructure's role. It encourages foreign central banks to accumulate yuan reserves. It gradually enhances its standing in the global reserve hierarchy. Individually, these moves seem minor. Collectively, they construct a new stratum of financial power outside G7 dominance. Historically, major powers sought to avert open currency warfare. G7 states often issued joint communiques discouraging deliberate devaluation for competitive gain. These accords aim to prevent economic catastrophe reminiscent of the 1930s, when beggar thy neighbor policies deepened the Great Depression. But as multipolarity intensifies, these legacy understandings are eroding. Emerging powers resist rules they had no hand in drafting. China's ambitions transcend trade and reserves. It's investing aggressively in regional financial plumbing, cross-border settlement platforms, central bank digital currency pilots, bilateral swap lines with monetary authorities across multiple continents. These instruments enable nations to transact and settle without routing through traditional Western banking rails. Over time, this builds parallel architecture. The danger here is fragmentation. Instead of one unified global financial ecosystem, multiple competing blocks may emerge. If currency tensions escalate, this could morph into a new form of currency conflict, waged not solely through rapid devaluations, but through influence networks, alliances, and alternative systems that fracture the global monetary order into rival spheres. Inside Japan, the most vulnerable constituency isn't multinational corporations or financial institutions. It's the average household. A depreciated yen means imported goods become prohibitively expensive. Utility bills surge because Japan imports the vast majority of its fuel. Grocery prices climb as substantial agricultural and livestock inputs are sourced abroad. Even routine household goods experience creeping price escalation. For families whose earnings have remained stagnant for decades, this creates quiet financial asphyxiation. Savings erode in real terms. Monthly budgets stretch painfully. The pressure accumulates not abruptly but insidiously, and that gradual compression makes it systemically dangerous. The instruments available to reverse this weakness carry heavy trade-offs. Currency intervention demands expending foreign reserves, which aren't limitless. If authorities intervene repeatedly, markets may probe those limits. Each intervention wave can stabilize temporarily, but also heightens volatility if traders anticipate and counteract future moves. This creates a cycle where stability becomes progressively harder to sustain. Meanwhile, accelerated interest rate hikes could throttle corporate investment and magnify the burden of Japan's massive public debt. The contagion doesn't respect borders. Asia is intricately linked through commerce, supply networks, and capital flows. A plunging yen disrupts exporters and importers regionally. Some economies benefit from a weakened competitor. Others suffer as their own currencies get dragged into the vortex. Global portfolio managers, sensing instability, may withdraw capital from Asian assets toward safer havens, amplifying pressure on developing economies and their monetary units. This kind of capital flight propagates faster than news cycles. It can destabilize entire markets within hours. On a strategic plane, the shift is even graver. As Japan battles to stabilize its currency, China accumulates leverage, not through coercion, but through opportunism. Financial vulnerability becomes diplomatic vulnerability. Negotiating positions shift. Regional allies diversify their hedges. Power equilibriums adjust. Quietly, Japan adopts a more defensive posture while China presses forward in a system where economic strength dictates influence. One plausible trajectory is decisive Japanese action. The government intervenes forcefully in forks markets, and the central bank implements meaningful rate increases with conviction. This broadcasts strength. Investors recognize improved returns on Japanese assets. Capital reverses direction. The yen stabilizes. Volatility subsides. Import costs plateau. Households experience marginal relief. Yet even in this scenario, the price is substantial. Elevated rates increase financing costs for enterprises. Government debt becomes more burdensome to service. Economic expansion decelerates before discovering new equilibrium. Stability is purchased, but through short-term hardship and prolonged structural adjustment. Another trajectory is chaotic drift. Japan hesitates. The yen continues its descent. Inflation intensifies as imports grow costlier. Energy expenditures remain elevated. Food prices keep ascending. Wages lag persistently. Public discontent mounts. Political backlash intensifies. Global investors begin categorizing Japan as a structural liability rather than a stable developed market. This magnifies turbulence. Speculators attack the currency more ferociously. Simultaneously, regional counterparts recalibrate their own policies to insulate themselves from Japanese instability. This propagates broader financial stress across Asia. When geopolitical risk escalates because economic weakness constrains Japan's strategic flexibility regionally. Then there's the third trajectory, the most consequential. China opts for assertive expansion. It allows the yuan to depreciate in tandem with the yen or deploys financial instruments to extend its reach more aggressively. Regional partners receive trade incentives denominated in yuan. Financial agreements circumvent legacy Western conduits. Subtle pressure is applied to smaller economies to align with Chinese systems. This recalibrates the balance, not instantaneously, but steadily. Japan, already strained by currency weakness, confronts a contracting sphere of influence. Global markets detect structural transformation. Rather than a singular integrated financial system, competing blocks solidify. Trade channels realign around these blocks. Investors face binary choices. Each of these pathways doesn't exist in isolation. They intersect. They influence one another. The ultimate direction hinges on decisions made in confidential central bank chambers and closed-door political negotiations, far removed from public scrutiny. The yen's collapse isn't merely a narrative about figures on an exchange rate screen. It's a chronicle of power, pressure, and positioning. Japan isn't only combating inflation or defending exchange rates, it's defending its role in a shifting world order. Simultaneously, China isn't simply managing domestic economic levers. It's testing how extensively it can project influence within a financial architecture constructed without its input. This is why the falling yen transcends local concern. It's a geopolitical barometer. For decades, global finance orbited a handful of dominant centers. The rulebook was largely authored and enforced by the same coalition of nations. Now that equilibrium is fracturing, a weak yen, sluggish policy responses, and China's ascending financial footprint are all connected to a profound transition. This could mark an inflection point, not because one currency is depreciating, but because the scaffolding around global money, commerce, and authority is being restructured in real time. What unfolds next depends on several pivotal moves. Monitor upcoming Bank of Japan policy sessions and whether rates finally rise substantively. Track how China manages the yuan and whether it continues constructing trade and settlement infrastructure outside traditional Western frameworks. Observe how the G7 responds. Will it coordinate like in previous crises, or will individual nations act unilaterally in an increasingly multipolar landscape? These aren't trivial developments. They will determine how capital circulates, how power migrates, and how resilient the global economy remains in coming years. If you want to anticipate these shifts and understand how international events interconnect beneath the surface, stay with America True Desk. Like this video if you found it valuable, and subscribe to our channel for more thorough, lucid, and impactful explorations of global finance and geopolitics.